My dear students, welcome back to our channel. In this video, I will be explaining the BCom first semester subject Financial Accounting 1 as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: explain the objectives of accounting. Objectives of accounting. Accounting is like a language of business that helps us record, summarize, and understand financial information. The main objectives of accounting are: 1. Recording transactions, bookkeeping. Every business transaction, like buying goods or paying salaries, is recorded systematically. Example: if Ram buys goods worth 10,000 rupees, it is recorded in the books. 2. Providing information for decision making. Accounting helps owners and managers make decisions about buying, selling, investing, or borrowing. Example: by seeing the profit report, a shop owner decides whether to expand the business. 3. Assessing financial position. Accounting shows what a business owns, assets, and owes, liabilities, at a given time. Example: a balance sheet shows that Ram's assets are 50,000 rupees and liabilities 20,000 rupees. 4. Measuring profit or loss. Accounting helps determine how much profit or loss the business made over a period. 5. Legal compliance. Accounting ensures the business follows laws, like paying taxes correctly. In short, accounting keeps business organized, helps in decision-making, and shows the financial health clearly. Next important short question is: 2. What are the fundamental accounting concepts? Discuss. Fundamental accounting concepts. Accounting concepts are basic rules or assumptions that guide how we record and report financial transactions. They make accounting consistent, reliable, and understandable. The main fundamental concepts are: 1. Business entity concept. The business is separate from its owner. Example: if Ram invests 50,000 rupees in his shop, the business books show it as the business's capital, not Ram's personal money. 2. Going concern concept. Business is assumed to continue operating in the foreseeable future. Example: assets like machinery are recorded at cost, not at their immediate sale value. 3. Money measurement concept. Only transactions measurable in money are recorded. Example: employee skill is important but not recorded because it cannot be measured in. 4. Cost concept. Assets are recorded at their purchase cost. Example: land bought for 1 lakh rupees is shown at 1 lakh rupees, not its current market value. 5. Matching concept. Expenses are recorded in the same period as the income they help earn. Example: rent paid for April is matched with April's income. These concepts help maintain clarity, consistency, and reliability in accounting. Next important short question is: 3. Significance of accounting standards. Accounting standards are rules and guidelines issued by the Accounting Standards Board (ASB) to ensure that financial statements are consistent, reliable, and comparable. They are important because: 1. Uniformity. Standards ensure all businesses record and report transactions in the same way. Example: two companies reporting depreciation will use the same method, making it easier to compare. 2. Reliability. Financial statements prepared according to standards are more accurate and trustworthy. Example: investors can rely on a company's reported profit before investing. 3. Transparency. Accounting standards make business transactions clear for users like owners, banks, and government. Example: loan providers can see a company's real financial position. 4. Legal compliance. Following standards helps businesses meet legal and regulatory requirements. 5. Decision making. Standardized reports help managers and investors make informed decisions. In short, accounting standards bring order, trust, and clarity in accounting, helping businesses and stakeholders make smart decisions. Next important short question is: 4. What is accounting cycle? The accounting cycle is a series of steps followed to record, process, and report financial transactions of a business. It ensures that all financial information is accurate and complete. The main steps are: 1. Recording transactions in journal. Every business transaction is first recorded chronologically. Example: Ram buys goods worth 10,000 rupees. It is recorded in the journal. 2. Posting to ledger. Journal entries are transferred to individual accounts in the ledger. Example: Purchase account and cash account are updated. 3. Preparing trial balance. All ledger balances are totaled to check that debits is equal to credits. 4. Adjusting entries. Necessary adjustments are made for accrued or prepaid items. 5. Financial statements. Final step is preparing profit and loss account and balance sheet to show profit, loss, and financial position. In short, the accounting cycle is like a loop. It starts with recording transactions and ends with financial statements, helping the business stay organized and accurate. Next important short question is: 5. Distinguish bookkeeping from accounting. Difference between bookkeeping and accounting. Bookkeeping and accounting are related, but they are not the same. 1. Definition. Bookkeeping is the process of recording daily financial transactions in an orderly way. Accounting is the process of classifying, summarizing, analyzing, and interpreting these transactions to prepare financial statements. 2. Scope. Bookkeeping has a narrow scope. It deals only with recording. Accounting has a wider scope. It includes recording, summarizing, and reporting. 3. Purpose. Bookkeeping aims to maintain complete and accurate records. Accounting aims to understand business performance and financial position. 4. Example. Recording cash received from a customer in the cash book, bookkeeping. Preparing profit and loss account and balance sheet from records, accounting. In short, bookkeeping is the foundation, and accounting is the complete process to make sense of financial information. Next, Unit 1. Long questions. First important long question is: what is accounting? What are the objectives and functions of financial accounting? What is accounting? Accounting is the systematic process of recording, classifying, summarizing, and interpreting financial transactions of a business. It is often called the language of business because it communicates financial information to users such as owners, managers, investors, and creditors. Example: if a shopkeeper sells goods worth 5,000 rupees, accounting helps record this transaction, show it in accounts, and later reflect it in financial statements to know profit. Objectives of financial accounting. The main objectives of financial accounting are: 1. Recording business transactions, to maintain a complete record of all financial transactions in an organized way. Example: recording cash received from customers or payment made to suppliers. 2. Measuring profit or loss, to find out the financial performance of the business over a period. Example: by preparing the profit and loss account, a business can see whether it earned a profit of 50,000 rupees or incurred a loss. 3. Determining financial position, to show what the business owns, assets, and owes, liabilities, at a particular date. Example: A balance sheet shows the company's assets like cash 1 lakh rupees and liabilities like bank loan 50,000 rupees. 4. Facilitating decision-making to provide useful information for management and investors to make decisions. Example, if sales are increasing, the owner may decide to expand the business. 5. Ensuring legal compliance to meet legal requirements like paying taxes and following accounting standards. Example, accurate accounting helps in filing correct income tax returns. Functions of financial accounting. Recording, keeping systematic records of all transactions. Classifying, grouping similar transactions in accounts. Summarizing, preparing trial balances, profit and loss accounts and balance sheets. Interpreting, analyzing financial statements to understand business health. Communicating, providing useful information to users like owners, investors, and creditors. In short, accounting organizes business information, measures profit, shows financial position, aids decisions, and ensures legal compliance. Without accounting, managing a business would be like sailing a ship without a compass. Next important long question is: to explain the advantage and limitations of financial accounting. Advantages and limitations of financial accounting. Financial accounting is the backbone of any business as it records, summarizes, and reports financial information. Like any system, it has both advantages and limitations. Advantages of financial accounting. 1. Systematic recording of transactions. All business transactions are recorded in an organized manner, making it easy to track and retrieve information. Example, if a business buys goods worth 20,000 rupees, it is recorded in the purchase account for future reference. 2. Helps in decision-making. Financial statements prepared through accounting provide important information for owners, managers, and investors. Example, if the profit and loss account shows increasing profit, the owner may decide to expand the business. 3. Determines financial position. It shows what the business owns, assets, and owes, liabilities, at a particular date. Example, a balance sheet may show cash 50,000 rupees, inventory 30,000 rupees, and liabilities 40,000 rupees. 4. Legal and tax compliance. Accurate accounting ensures businesses meet legal obligations and pay correct taxes. 5. Facilitates comparison. Accounting allows comparison of financial performance over different periods or with other businesses. Example, comparing this year's profit with last year's helps identify growth trends. Limitations of financial accounting. 1. Historical in nature. It records past transactions and may not reflect current business conditions. Example, assets are shown at historical cost, not market value. 2. Ignores non-monetary factors. It does not consider employee skills, customer satisfaction, or goodwill unless they can be measured in money. 3. Limited use for decision-making. It provides financial data but may not fully guide strategic decisions like marketing or expansion. 4. Subject to human error or fraud. Mistakes in recording or manipulation of accounts can lead to inaccurate information. In short, financial accounting is essential for recording, summarizing, and reporting financial information. It helps in decision-making, legal compliance, and assessing financial health, but it cannot capture non-financial factors and mostly shows past performance. Next important long question is: 3. Explain the accounting systems. What are the differences between single-entry system and double-entry system? Accounting systems. An accounting system is a method or process through which a business records its financial transactions. It provides a structured way to collect, organize, and report financial information. There are two main types of accounting systems. 1. Single entry system. In this system, only one aspect of a transaction is recorded, usually in a cash book or personal account. It is incomplete and simple, suitable for small businesses with few transactions. Example, if Ram receives 10,000 rupees from a customer, only the cash account is updated, the customer's account may not be maintained. Limitation, it cannot easily show profit loss or financial position accurately. 2. Double entry system. In this system, both aspects of every transaction are recorded, debit and credit. It is complete and accurate, suitable for all businesses. Example, if Ram buys goods worth 5,000 rupees on cash. Purchase account, debit, 5,000 rupees. Cash account, credit, 5,000 rupees. This system ensures debits is equal to credits, allowing preparation of trial balance, profit and loss account, and balance sheet. Advantage, shows financial position and profit loss clearly reduces errors. Differences between single entry and double entry system. Basis single entry double entry. Completeness incomplete complete. Accounts maintained only cash and personal accounts all accounts, real, personal, nominal. Profit measurement difficult easy to calculate. Error detection difficult easier through trial balance. Suitability small businesses all businesses. In short, single entry is simple but limited and error-prone. Double entry is systematic, accurate, and forms the foundation of modern accounting. Using double entry, a business can track transactions, measure profit, and know its financial position with clarity. Next important long question is 4. Discuss briefly the various accounting concepts and conventions. Accounting concepts and conventions. Accounting is guided by certain concepts and conventions that ensure financial information is consistent, reliable, and comparable. These are the rules businesses follow while recording and reporting transactions. Key accounting concepts. 1. Business entity concept. The business is treated as separate from its owner. Example, if Ram invests 50,000 rupees in his shop, it is recorded as business capital, not his personal money. 2. Going concern concept. Business is assumed to continue operating for the foreseeable future. Example, assets like machinery are shown at cost, not liquidation value. 3. Money measurement concept. Only transactions measurable in money are recorded. Example, employee skill is important but not recorded because it cannot be expressed in. 4. Cost concept. Assets are recorded at their purchase cost, not market value. Example, land bought for 1 lakh rupees is shown at 1 lakh rupees in books, even if its current market value is 1,50,000 rupees. 5. Matching concept. Expenses are recorded in the same period as the income they help generate. Example, rent paid for April is matched with April's income. Important accounting conventions. 1. Consistency convention. Once a method is adopted, it should be followed consistently. Example, depreciation method used last year should be continued this year. 2. Conservatism prudence convention. Anticipate no profits but record all possible losses. Example, if a customer may not pay 5,000 rupees, record it as a loss, but don't record expected profit until earned. 3. Materiality convention. Only significant transactions are recorded in detail. Example, Small stationery purchase of 200 rupee may be grouped instead of recording individually. 4. Full disclosure convention. All important information must be disclosed in financial statements. Example, any pending legal case affecting finances should be mentioned in notes to accounts. In short, accounting concepts are the basic assumptions and conventions are the practical guidelines. Following them ensures accuracy, reliability, and comparability, helping businesses make informed decisions and present financial information clearly. Next important problem is 5. Journalize the following transactions in the book of Mr. Siddharth. 2021 1st January started business with cash 5 lakhs rupees. 2nd January deposited into ICICI 2 lakhs rupees. 3rd January brought goods on credit from Sai 50,000 rupees. 5th January sold goods to Lakshman on credit 1,50,000 rupees. 10th January paid to Sai, on full settlement, 49,000 rupees. 15th January received from Lakshman 1,45,000 rupees. Allowed discount 5,000 rupees. 20th January paid wages 5,000 rupees. 25th January paid rent 40,000 rupees. 30th January paid salary by check 60,000 rupees. Here's a simple, step-by-step solution for the Journal of Mr. Siddharth. Journal of Mr. Siddharth for January 2021. Explanation. In journalizing, we record each transaction in chronological order. For every transaction, the debit account comes first and the credit account comes next. Date particulars LF debit, Rs, credit, Rs. 1st January cash ACDR. To capital AC 5 lakhs 5 lakhs. Started business with cash. 2nd January bank ACDR. To cash AC 2 lakhs 2 lakhs. Deposited cash into ICICI. 3rd January purchases ACDR. To Sai AC 50,000 50,000. Bought goods on credit from Sai. 5th January Lakshman ACDR. To sales AC 1,50,000 1,50,000. Sold goods to Lakshman on credit. 10th January Sai ACDR. To cash AC 49,000 49,000. Paid Sai in full settlement. 15th January cash ACDR 1,45,000 discount allowed ACDR 5,000 to Lakshman AC 1,50,000 1,50,000. Received from Lakshman with discount allowed. 20th January wages ACDR. To cash AC 5,000 5,000. Paid wages. 25th January rent ACDR. To cash AC 40,000 40,000. Paid rent. 30th January salary ACDR. To bank AC 60,000 60,000. Paid salary by check. Step-by-step explanation for easy understanding. 1. 1st January, Ram starts business cash increases debit cash, credit capital. 2. 2nd January, deposited cash into bank debit bank, credit cash. 3. 3rd January, bought goods on credit debit purchases, expense, credit Sai, liability. 4. 5th January, sold goods on credit debit Lakshman, asset, credit sales, income. 5. 10th January, paid supplier debit Sai, liability decreases, credit cash. 6. 15th January, received from customer with discount debit cash plus discount allowed, credit Lakshman. 7. 20th January, paid wages debit wages, expense, credit cash. 8. 25th January, paid rent debit rent, expense, credit cash. 9. 30th January, paid salary by check debit salary, expense, credit bank. Tips to remember. Debit what comes in, credit what goes out. expenses and assets are debited, income and liabilities are credited. Always record in chronological order.